Economy Unpacked is a new series from us to understand difficult questions about the economy. In this first edition, we are trying to answer some key confusions on interest rates emanating from Reserve Bank's actions. Confusion number one, Reserve Bank cut interest rates by 50 basis points on June 6th, but said it was moving stance to neutral from accommodative. Bond yields, which should have fallen after the massive rate cut, actually ended up rising because market concluded no more rate cuts. However, the 2.8% May inflation has rekindled hopes of another rate cut. Now, confusion number two. Will Reserve Bank keep liquidity just enough so that the overnight call rate comes towards the repo rate of 5.5%? Or will call rate remain at 5.25%? Now, immediately after the policy, yields rose and then they fell below 5.25%. In fact, they went to 5% mark because Governor said that rate cut transmission is still in early stages. So market concluded liquidity will remain surplus. But last week on June 24th, Reserve Bank announced a massive 7-day VRRR, variable rate reverse repo of 1 trillion rupees, which means Reserve Bank is absorbing 1 trillion of liquidity. So yields rose. Market is still confused. If Reserve Bank will continue to do VRRRs and hence absorb liquidity, push up the call rate to 5.5%, or will it do VRRR only when liquidity gets too plentiful? Now, for all these questions, I'm joined by an elite panel of experts: Samiran, Chakraborty, Chief Economist, Citi India; Neeraj, Gambhir, Group Executive and Head Treasury Markets and Wholesale Banking at Axis Bank; Srini Varadarajan, Banking Veteran and Market Expert. Before I shoot my first question, for those of you who are equity expert viewers, just 2 or 3 terms. One, when we say VRRR, variable rate reverse repo, the RBI is pulling money out of the system for a temporary period. Overnight call rate is the market where banks borrow from one another for 1 day. And the TREPS market is where mutual funds, insurance companies, banks, all of them borrow from one another for 1 day. We will use these jargon. But let me get to the expert. First, Neeraj, what did you make of this VRRR? Are you getting a feeling that Reserve Bank is now going to bring the call rate to 5.5%?
I think that looks like to be the case. To me, it feels like that after announcing the change in stance to neutral from accommodative, Reserve Bank is not very comfortable with call money rates trading significantly below the repo rate. And I think this introduction of the 7-day VRRR, and market is sensing that there could potentially be an extension to overnight VRRRs, which means basically RBI taking out money from the system at repo rate, will basically fix the floor of rates at repo rate. It was about 25 basis points lower. Now it's going to be closer to the repo rate. What this basically means is that if the overnight gets fixed at repo rate, which is 5.5%, all the other rates in the money market, whether it's T-bill yields or whether it is CP/CD rates, will get indexed to this rate. And therefore, in some senses, there is going to be a little bit of upward bias towards these money market rates as a result of this action. We will...
Yeah, go ahead.
No, I'm just saying that this is something which is a bit of a change in their operating procedure of monetary policy post the recent MPC meeting. And I think it is more of an alignment of their operating procedures and operations in line with the change in the stance from accommodative to neutral.
Now, I'll tell you, the governor was very clear, not this policy, but in previous policies, that when they change the stance, they are not referring to liquidity. They are referring to their view of repo rate. I remember them, I'm not quoting verbatim, but I remember them saying that. But Samiran, what are your thoughts? Is it not possible that the RBI and the governor were alarmed that call rate went even below 5.25%? And I think at one point there was one trade even below 5%. And TREPS market, there the rates went really towards 5% and below 5%. So they're only correcting this distortion, but they don't want the call rate to come from 5.25% to 5.5%. Is that one way of looking at it?
So, I will agree with Neeraj on this, that it appears that this is in sync with the RBI's change of monetary policy stance from accommodative to neutral. Till the monetary policy stance was accommodative, RBI was allowing the overnight rates to be closer to the reverse repo rate rather than the repo rate. Now, since the stance has changed, the sanctity of the monetary policy framework needs to be preserved, because as of now, in the inflation targeting framework, the operating procedure of monetary policy is to keep the weighted average call rate close to the repo rate under usual circumstances. So because the market is right now, in my view, in a pretty much normal situation, for RBI to have this sort of abnormal thing of having the overnight rate much lower than the repo rate probably wouldn't have made sense. But at the same time, I don't think it has any signal for future rate action. They can still go in for rate cuts in the future, and through that bring down the overnight rate. That's probably a cleaner way of doing this rather than having this sort of stealth method of a rate cut.
Okay, Srini, I just want to present to you, and you would have heard this, of course, what the governor said in the Business Standard interview. He said, keeping liquidity surplus helps rate cut transmission. RBI will continue to weigh the trade-off between keeping call rate at SDF rate for better transmission or at repo as the framework requires. Broadly, those were his words. You would know much better about transmission. Has transmission really taken off? If the governor and the RBI want transmission, will they push up the yield from 5/4 to 5.5?
Transmission. Is transmission something to do with lending rates, or transmission something to do with the deposit rates? And clearly, I think, and the way I look at how the policy and the rate cuts have sort of happened over the last few months, it looks like, I think the RBI would like immediate transmission or transmission to happen as quickly as possible. And that they are trying to do it through rate cuts because the EBLR immediately sort of resets. And I think that is forcing the transmission on the lending side to make sure that if there is a facilitative environment which can be created for credit growth and therefore trigger some amount of activity in the economy, let us facilitate that. So that to some extent is one aspect of transmission, because the fact that transmission through cost of deposits coming down is a process which is taking longer. And in my view, the way the market structure is today, that is unlikely to happen, because there are always going to be banks which are going to be borrowing at high rates. And what CDs and bulk deposits coming down is not reflective of the liability profile of banks, because these are the two products which the regulator doesn't want banks to rely on. They want banks to rely on our retail term deposits and CASA. That to some extent is not changing much with any of the rate cuts, and it's only liquidity to some extent which is sort of impacting that. So I think there is a basic issue is what is the policy rate seeking to achieve? Is it seeking to achieve lower lending rates, which is what I think RBI has now come down to, saying that, okay, if I cut rates, I will push the EBLR lower, and then the banks will have to then manage their own liquidity and profitability. And then that's why we've seen banks sort of look at savings rate to immediately reduce their cost of funds. So to me, it looks like we have to relook at what the policy rate is supposed to do. Because if the repo rate right now impacts only T-bills and to some extent GSEC, and long-term GSEC also it is getting slow, the cost of funds of banks and the policy rate, I think are right now the sensitivity is becoming lower and lower. I think lower.
1 minute, Srini, 1 minute. In the past, RBI has told me and bankers have told me that, when there is plentiful liquidity, you're actually putting money in SDF, we are bolder to reduce deposit rates. When we are kind of depending on the call rate to borrow, at that time, we are not in a mood to reduce deposit rates. So the Reserve Bank does make a connect that lending rates, of course, are linked to EBLR. Once repo rate is cut, many lending rates are cut. But deposit rates fall. As you say, many banks are hamstrung. And the Reserve Bank's psyche, at least in the past, I didn't speak to this governor, in the past is bankers are in a better mood to cut deposit rates when there is plentiful liquidity. Do you buy that? And if you buy that, that means they will be keeping liquidity plentiful?
You would have to look at the average cost of retail term deposits for this quarter and the coming quarters. I would suspect that it is going to be not more than 50% of the extent of rate cuts. And I think that is primarily because there are high rate borrowing banks which will continue to do at those rates. They are not getting rates lower. Only the banks which have, to some extent, a large depositor base and which have clearly sticky customers are in a position to do it. So therefore, if you look at the system level retail term deposits, I don't think so the transmission is going to be so easy because the power equations of different banks are different. And I think the consolidation of market shares among different banks is happening at such a pace that I think the people who are left out are never going to be able to lower their deposit rates.
So your short point is he will bring the VRR to the call rate to repo rate?
Now, basically what I'm saying is RBI is forcing banks to lower their lending rates through the repo rate cut by the EBLR mechanism.
Okay.
And then it's up to the banks to manage a liquidity profile in terms of what they want to lower, how they want to lower, and try and manage their NIMs, margins, and profitability.
All right. Okay. Neeraj, what is your sense about, therefore, another rate cut? If the RBI is already bringing the call rate to the repo rate, then does that reduce are they giving an indication that there isn't scope for rate cut?
So before I come to another rate cut, let me just respond to this question of transmission. In my opinion, and it's a little different from what Srini said, this quarter and this cycle of rate cuts, we've seen one of the fastest transmissions on the liability side that I've ever seen in the banking system. We've already seen large banks cut their savings bank rate by approximately more than 50 basis points. We've seen a significant reduction in term deposit rates for retail. I'm not talking about the bulk or the CD rates. I think bulk and CD rates have actually come down by almost 130 basis points since their high in the March. So I would, I'm basically, my conclusion is that given the change in the structure of banks' balance sheets since 2019, where more than 50% of assets are now linked to EBLR, banks are being forced to relook at their liability pricing far more proactively and far more quickly than I have seen in the past. And obviously, Reserve Bank's massive liquidity injection that they have done over the last 4 months or 5 months has actually helped in the process. I think the fact that Reserve Bank kept the call money rate close to STF rate or lower end of the corridor has actually helped banks do significant repricing. Now, it's the structure of the balance sheet that the liabilities reprice at a slower pace as compared to the asset. The asset repricing is almost instantaneous. It happens within a quarter. The liabilities take time to reprice from a stock perspective. But from an incremental perspective, I think banks have taken a lot of action in terms of bringing down their retail deposit rates. Obviously, I'm talking about large banks, not the entire banking system.
Okay.
As far as the future rate cuts are concerned, I don't think that this action of normalizing the call rate to repo rate is any indication of what Reserve Bank may end up in the future. I think the door is still open for further rate cuts, provided we see inflation continuing to come down and there is some weakness in the growth. But I think the bar is a little bit higher in my opinion.
Samiran, I have to take a break, but I want a quick reply. Do you think if you're in the Reserve Bank's shoes, you will be satisfied with this level of transmission? I mean, credit growth is really abysmal.
So there is a bank lending channel of transmission and there is a bond market channel of transmission. The governor in his interview has clearly mentioned that both are equally important. I think definitely the bank lending channel is working fine. Whether the bond market channel is working fine or not, how much patience RBI can show on that, that's something that we have to see.
Okay, fair enough. I have to take a quick break, but I'm going to ask now even for the CRR views and how the Reserve Bank will approach it in the future as well on rate cut transmission. The entire conversation is going into CNBC Access. So viewers, you can catch the full conversation of Economy Unpacked post-market hours on CNBC Access. After a break, Chartbusters for you.